All right, welcome to another live trading session. Today is Tuesday, October the 3rd, and we're going to take a look at the market. Then we're going to take a look at our account and our metrics and see where we stand. So first, let's take a look here. And as we can see here, market is going down, continues the move that started quite some weeks ago, and that's all. We just take a quick glance. We don't really care much about the market going up or down. We trade according to our rules that are tied to the market movements, to the changes in VIX and stuff, but we don't really care about particular moves so much. So let's take a look at our account first and see where we're at. The market is down, as we can see here, 1.4%, and we are down 400 and change. And on our account balance of 48,000, that would be less than 1%. And so we're doing a little bit better than the market, and this is thanks to our ES hedge on demand that's bringing in some profit, and our SPY grind down protection that's also bringing in some profit. And these two are integral part of the one-to-one trading system, because our one-to-one is our main income trade, but as a protection we have a grind down protection that's in SPY, and the SPY obviously reacts the same way and with the same intensity as the MES or ES would, just a different instrument. And our ES is our hedge on demand that gets activated once the market starts heading south, and protects us there. So this would, if the market continues to go down, obviously this profit would go higher, and if the market reverses, this hedge would start losing money, and at some point it could be taken out for a loss, which would mean that the market has reversed or stopped going down, and in that case this would be paper profit at the moment. But same is true with our loss on the MES one-to-one trades. Then they would also prove to be just a paper loss. So either way, if we keep losing money here, then we have to keep making money here. And then we have our SPY trades here that are bringing in money, and that one is we currently have two debit spreads, and one of them is starting to get in the money right here, and this one is bringing in 158, and the second one is not in the money, but it's getting in that direction. That one is bringing in a little bit. Now this one could be closed for the profit. Even if the market reverses or slows down, we can take this at some point for profit. We're not going to wait for these to get fully in the profit, or that's on that. So we are in perfectly good shape as far as that is concerned for right now. So what we need to take a look is our metrics, and to do that, let's go here and take a look at the VIX. VIX is at 1987, so 1987. Portfolio delta is 52, theta 45, so 52 and 45, and our buying power that's showing right here, and I'm gonna refresh it. So we're concerned with MES. This also includes the ES hedge as well, but we can't separate it, so we have to look at it as a whole for the moment. And we are at 20.7. Now we're going to take out the whatever metrics are brought in by the hedge. So for the ES, we'll quickly take a look how much buying power use would increase if we were to close this hedge. So 2290, we're going to clear and close that, 2290. So this is what the hedge is bringing in, the buying power relief, 2290. And then our hedge is also bringing in negative 35 deltas and 14 theta, 35 and 14, right? So minus 35 and minus 14. So by bringing in these numbers here, we normalize our account delta, theta, all of the metrics. We normalize them. We have 13 open trades. So we're going to take a look at the whole picture here, right? So according to our buying power and currently open number of trades, we still have room, because we could go up to 36% in buying power, but we are actually at 25. We are actually at less at the moment, showing in the whole account. But if we take the buying power relief provided by the hedge, we increase. This is a safety precaution measure, so we don't overextend ourselves, because the hedge will be closed at some point, and then the metrics would shift. So buying power 25, our theta 06, we monitor it, but we're not going to put on trade just because the theta is low, or we're not going to really take any trades off just because we're a little bit high on thetas. But delta we do monitor, and they're at 18. The real delta is 0.18. The ones with the hedges is at 0.11. So 0.18, it's orange. It means we're very close to our maximum, which would be 20 here. So there's once it's orange, that means it's at our discretion whether we're going to put a trade or not. But given that everything else is green, the theta, the buying power, the number of trades that we have open, I think we should consider, and it's a nice down day, so we will get decent premium for our nakeds, and it would be a good day to do a trade, even though I know, yes, we might go further down tomorrow. That's part of the game. Our metrics are in line, so that's fine. If we go further down tomorrow, we'll reevaluate tomorrow and see where we at. We can take a look. Well, let's see. Let's start with 72, right? Let's see where we at. So we could get decent premium at 37. The only problem with that would be what strike here, 70. We're looking for roughly 70% in duration for our put debit spreads. So at 72, that would mean 7 times 7, 49, so around 50. So we have 45 and 58 available. They're both a little bit too far out of the ideal. So let's just take a look at 87. So if we have 87, that would be, if we look 70% of 87, that would be close to 9 times 7, 63, a little bit less. So 60, 61, 2. So we could go 87 and 58. That's closer to the ratio we would like. So let's see what happens if we go. Let's first clear the old trade. And let's go here to 9 delta. Okay, so here we can get 23.75. We can certainly consider that. Let's see. Let's just try and see if we can get a little bit more for them. Unlikely, but it doesn't hurt to check. Replace. Go a little bit down. Go to the middle. Okay, and it's filled. And this is 23.50. So real quick here, if 23.50 times 2. So we brought in a total of 47, and then times 0.25. So we're looking to spend around $11.5, $12 for a PDS. So we go to our 58, and we go to roughly 9 or 10 delta just to start. So let's see here. If we go here, just for ease, 38 and 35, we can move them around easily afterwards. Okay, so this one is a little bit on the high side, so why don't we just go down by well, roughly, there's no strikes here, so 75, 11. Okay, this looks very nice, so we're gonna just go ahead and see if we can get it like this, and if not, we're gonna just do this. Now wait a little bit, see if we can get filled here. And even if we go to 11.5, we should be able to close this. Even if we pay 11.5, which we just did, that's fine. That's still, so we're still paying around 25% for our put debit spread off of the premium collect, right? So it's important to know that we have to have some protection, and that's what we do with our SPY. So we allocate a certain percentage of our premium on a weekly basis. We will be roughly 10% of our premium we will use to buy put debit spreads that will stay there. We don't count on them making money, and long term they should break even, as they're most of the times they will lose money. About 20% of the time they might bring in some money. So they shouldn't be a big losers, but the good thing is you're losing on them when you're making money on the overall on your one-to-one trades, and then you're making money of them when you're losing on the one-to-one trades, which stabilizes account, which you can see right here as we speak, right? So if you take a look here, our one-to-ones, and this one now has a couple of trades, the new expiration. Our one-to-ones are losing close to 800 here now for the day, but our SPY put debit spreads are bringing in 140, and our hedge is bringing 230. So we are amortizing all of this hit from the market movement down. And if you take a look at just our regular trades here, the one-to-ones, the ones that are getting closer to having to be managed, those are the ones that are approaching 30 delta on naked puts. Now, there is no way, I couldn't find any way on Tasty to show individual deltas here for those trades, but I have a little shortcut, a little trick, and that is by looking at these deltas here. And if you just take, because there's two of them on each of these, and MES is a 5 multiplier. If it's two of them, it's a 10 multiplier. So if you basically divide this, if it says 25 here, that means that each individual strike on this is actually 25 delta. And to show you that, I can just, let me just open this one. Let's say we're gonna close, let's say one of them. As you can see here, this one is 25 delta on the MES, which then gets translated into a different amount for the multiplier for the SPY weighted deltas. But this is a shortcut, so you can see where your positions are standing at the moment. And as I said, if you take a look here, nothing is at 30 delta, and we're fine. If something would get to 30 delta, and that would be possibly this one, if we continue to go down, and let me see, then this one is at 22, and this one is at 23. We would then look into rolling those naked puts a little bit further out in time and a little bit down in a price, in the strike, and that would bring us to a little bit lower delta, and we would look to spend no money for that. We would do that at break even, or just a little bit of profit just to cover the commissions. But what that would allow us to do is to realize a full potential of the put debit spread that's attached to that trade, or to those naked puts. Because if you take a look, for example, let's go to the one that's highest, that has 25 delta, this one right here. So you can see that those naked puts are now showing $285 loss. This is profit and loss since opening. However, the put debit spread, it's bringing $165 in relief, in profit, to offset that. So if we were to close the whole trade now, we would not be able to realize much of the full potential of the PDS. So by rolling, we allow more time for these put debit spreads to mature, and then we can hopefully look to close them if the market continues to go down, to close them for a higher profit. And if this happens, we would buy a new put debit spread once we close this one for a decent profit. We would put a new one to protect the naked puts that are still open. So I think we're in a good shape. And again, I know the market can go down tomorrow, but when market is going down, it's no time to panic. As long as all of our metrics are in line, and we don't overextend ourselves, we're doing fine. So I think that's all I had for today. Have a great rest of the day. See you next time. Thanks.